The monetary policy on June 6th is going to be announced under, shall we say, momentous changes in the political and economic backdrop. A government has been returned with an astounding mandate, which means political resources are high, very high. But the economy has just posted its slowest growth in 20 quarters. Under the circumstances, what should the Monetary Policy Committee do on June 6th when it announces the policy? Well, as always, CNBC-TV18 Citizens Monetary Policy Committee meets on the eve of the RBI's MPC meeting to deliberate on what ails the economy and what needs to be done. I have with me Chairman of the Citizens MPC, Dr. Pranab Sen, and members Shamiran Chakraborty, Shaumya Kanti Ghosh, Sajid Chenoy, and Sonal Verma. Gentlemen and lady, welcome to the deliberations. Well, let me start with the lady. Sonal, we've just got the GDP number. Just how bad is the growth slowdown problem?
Hi, Lata. I think the slowdown actually is on anticipated lines, and no matter how we slice or dice the data, it's clearly showing a slowdown in the underlying momentum. And what it is actually suggesting is that the economy has been hit both by the global shock and also the domestic shock, because both private consumption and investment have slowed down. I think the more important question is sort of the growth impulses going forward. And as of now, the numbers for the April as well as the early indications for May are that the growth momentum actually has continued to slow down. So I think the worry at this stage is that the growth impulses, both domestic and global, look quite weak, and therefore risks to the growth profile for FY20 are actually to the downside.
Okay, point taken. Sajid, let me come to you. You know, the MPC's primary mandate is inflation control. But now with global and domestic slowdown, as Sonal points out, is the inflation trajectory likely to be even lower than what RBI forecast in April? Is inflation no problem?
Well, Lata, I think, there'll be more comfort now that 4% target over the next 3 or 4 quarters is not under immediate threat. Because until a few months ago, the worry was that core inflation was very elevated, stuck around 5.5% for about 6 months at the end of last year. Food inflation was particularly artificially low, and the concern always was at some point food prices would bounce back, and that together with core inflation would take the headline number above 4%. Now with core momentum clearly slowing in the last 3-4 months, which is perhaps the best manifestation of what Sonal was saying, growth has slowed. I would argue both domestic consumption has slowed, exports will slow in the coming quarters given the global outlook, and when two engines suddenly slow, there is a real concern of hysteresis here in the economy. So with core inflation softening, it does two things. One is it kind of reaffirms to the MPC that growth momentum has slowed, and they had spoken about output gaps opening up 2 months ago. They'd probably think output gaps are getting a little bit bigger. And secondly, it provides comfort that even if there is some mean reversion of food prices, that the 4% target is protected. So I would argue, yes, the incremental information between the last review and this review is that perhaps more comfort that for now inflation is not to exceed 4%, and more concerns that both domestic growth and global growth momentum have slowed further.
Okay. Yes, that will not be a problem. Perhaps we're going to be south of 4% comfortably. But Samiran, traditionally a loose monetary policy, or when you are loosening the monetary policy, you have to have one eye on the fisc. At the moment, that looks like a problem. We don't know. The budget is a month away. But the tax revenues of last year have been, 1.6 lakh crores short. On that base, the February budget was expecting, some 15% tax revenue growth. It's clearly going to look like a fiscal breach. Is that okay at this point?
So traditionally, MPC has not second-guessed the government on the budget, so they will probably wait for the actual budget announcements before taking a firm call on the fiscal. But if we are right on our characterization that growth has definitely slowed down and inflation risks are not in the horizon, then the basic reason why we track fiscal so closely is to see its impact on inflation. So if we are more or less comfortable that inflation is on track, then you can for a while even tolerate a bit of a fiscal slippage as long as it is well understood that it is for a temporary period and it will come back on course. So from that perspective, I don't think in the June policy the MPC will be that much worried about fiscal slippage. This is a time to think of more growth, less of fiscal.
Okay, the MPC's mandate itself says to keep inflation under control while concentrating on growth. So this time you're pretty sure that that caveat is well taken care of, inflation control.
I mean, in a sense that, as Sajid was mentioning, that at least for the foreseeable future, we are not seeing inflation breaching the 4% mark. And in the past also, if you take like a relatively long period average, it's staying below 4% on a durable basis. So for a while, we could have justified having a somewhat tighter monetary policy because we were coming up from a very high inflation. So there was need to keep policy tighter to change inflation expectations. Now we have achieved it, and that's why we can look at growth more closely.
Okay. Well, as you say, we had kept the monetary policy tight. You know, the whole problem, Soumya, appears to be that even the rate cuts have not been transmitted. We are unable to loosen the policy effectively, even when we cut rates. So how do you assess the situation then?
Yeah, I think, Lata, this transmission has been a perennial problem in the banking sector. I think there are several idiosyncrasies involved. The first point is that the banks only borrow not more than 1.5% of the total liabilities from the repo window, which is basically the signal for transmission. Now, in the last 2-3 months, if you look into the data, the total currency leakage from the system last year has been 3 lakh crore, which is actually as a record high. And that has been one of the problems which deposit growth has been significantly lacking credit growth. And the problem is that if you actually, the banks also have to maintain SLR and LCR. Currently, if you do a very simple calculation, 15.5% of can be carved out from the for the 19% one. So that means the banks have to effectively maintain 19% SLR plus 3.5% because of LCR plus 2% margin. So effectively the banks have to hold around 24.5 to 25% of SLR, government securities. Now that number is coming down significantly. It is currently around at 26.2%. So therefore, until and unless the deposit growth rate picks up, the banks cannot sustain credit growth. And this situation is unlikely to revert in the next couple of months because there has been a significant currency leakage. If that is the case, banks cannot cut deposit rates. If the banks cannot cut deposit rates, lending rate transmission will be equally difficult. So given this issue, I think that transmission will remain an issue in the next couple of months. And for that, the Reserve Bank has to think some out-of-box ideas how to do that.
You know, I spoke with a very senior Reserve Bank official on this, and actually there is a little more LCR space available. In the previous policies, the Reserve Bank said you can bring down what you call the Volcker rule, facility to avail of liquidity under the LCR. You could bring down your LCR by 2 percentage points. The fact of the matter, this gentleman told me, is that most banks have not availed of it. So there is also a trust issue. Money available with banks, but not being lent to those who need. So I'll come to that in a minute. But Dr. Sen, can you put all the diagnosis together? We have spoken about inflation, growth, liquidity, deposit growth, and the fiscal situation. How would you assess the situation and diagnose the problem for the MPC?
I think everybody seems to be more or less agreed upon the inflation trajectory, the weakening of growth, the fact that, you know, we are at the moment in a situation where liquidity in the banking system is a concern. But the one thing we haven't talked about is, you know, Shomo talked about this leakage of 3 lakh crores of liquidity into currency. The question is, what is happening to that? This is not unexpected. I mean, pre-election this always happens. There's always cash being withdrawn for electioneering purposes. The real million-dollar question is how much of that is going to come back to the banking system and how much of that is going to be retained in the cash economy. Now, that's something that's going to play out over the next month or month and a half. So we'll have a fairly decent idea as to what is happening to bank liquidity in about a month or so. And that's something we need to keep a weather eye open for. But even if it doesn't come back in the banking system, I think we also need to be very clear that there was a liquidity constraint in the cash economy as well. And if that liquidity constraint is getting eased, then one should expect to see some growth returning essentially from the cash economy rebounding, which will not appear in the GDP data in the immediate future, will eventually find its way there about 3 to 4 quarters later.
Okay. So you're not that pessimistic on growth, should I gather?
The month is kind of... Well, yes and no. I think as far as the headline figures are concerned, which is the quarterly GDP figures, I am pessimistic. I think they'll continue to go down for a while yet. And the reason for that is that the after effects of the slowdown in the MSME sector are now starting to get played out in the corporate results. And this is going to take some time to reverse, because the process does have a fairly long lag sort of issue that's involved. So it will, next couple of 2-3 quarters, I expect the numbers to get worse and worse and worse.
Okay, maybe can we hasten the process to push in liquidity and improve economic activity? That we have been speaking with the Citizens Monetary Policy Committee members who habitually meet before the Reserve Bank's MPC meets, and we are asking them their diagnosis of the economy and their prescription for getting growth back on the rails. I mean, we all know growth is the problem. The just received GDP numbers being as bad as 5.8%, a 20-year low. Okay, I have with me Chairman Pranab Sen and members Samiran Chakraborty, Shaumyakanti Ghosh, Sajid Chenoy and Sonal Verma. Sonal, once again, let me start with you. Set the ball rolling. What do you think the MPC ought to do?
I think, Lata, we need to sort of go back to the drawing board to ask the question, what should be the MPC's priorities right now? And I think the #1 priority at this stage is really financial stability. The system actually is quite fragile. We've seen 8 months of the NBFC stress actually continuing, and therefore the interlinkage between NBFCs, mutual funds and banks, I think the problem has persisted for quite some time. Second, the growth problem, of course, is there, as we discussed. And third, like you said, it is all about transmission. At the end of the day, the rate cuts have not transmitted, and that's partly been because liquidity has been tight. I think that has changed now, but the commitment to keeping liquidity supportive needs to also come through. So I think if we keep all these 3 things together, the common factor here is that the liquidity conditions need to be positive. The skew on liquidity needs to be positive. So I think that's the #1 commitment that the Reserve Bank should be giving. And second, consistent with inflation being within the target, growth being below target, and financial stability actually being the #1 priority right now, I think it definitely calls for front-loading and preempting whatever rate cuts need to be delivered.
Sajid, actually, would you agree that a rate cut is not enough? There needs to be some signal on liquidity, and the MPC may even proactively make it clear that even with fiscal slippage, which looks maybe likely this time, the MPC should keep its accent on growth. Do you think that should be the message conveyed?
Well, that's a couple of things. One is, I think we should not overload with the inflation targeting framework with so many more objectives than instruments. I agree that financial stability is a concern, but there are regulatory measures that one can use. I agree that the NBFC sector is frozen, but we've been arguing that some kind of asset quality review, an AQR, will be necessary there to break the asymmetric information loop. I think the framework, so that it doesn't confuse markets, should go back to where is inflation, and if inflation is under 4%, where is growth? And now on your transmission issue, I think at the margin liquidity will help, but I think there are some steps that the government can take to enable higher monetary transmission. For example, those small savings rates being at the level they are make it harder for deposit growth to pick up, and when incremental credit deposit ratios get to the levels they are, it's going to be hard for banks to transmit rates. The curve, for the most part, except the last 3 weeks, has been very steep. I would argue because the public sector borrowing requirement is close to 9% of GDP. So my point is, while liquidity will help, there are some fiscal things the government can do, things on small saving schemes, which will help enable monetary transmission.
Actually, Sajid is making a point that if the fisc, which will, strain the economy, because now the Pradhan Mantri Kisan Yojana is not just for farmers with 5 acres, but for all farmers. So there is going to be a strain. Samir, and a slightly more technical question to you. There is no way deposit rates will come down when, as Soumya said, this is the gap between deposit growth and credit growth is so high. Banks simply are hankering for deposits. And even on the liquidity issue, I have a more technical problem. The way in which the Reserve Bank keeps the rate at the call rate, keeps the repo rate at the call rate, if it is committed to doing that, then how will they introduce more liquidity? How will they communicate that they are for a softer side?
So one part of your question is about a absolutely structural issue, which is the saving investment balance. I don't think we have any short-termish solution to a structural problem of increasing saving or even reducing public sector borrowing requirements overnight.
So even if the small savings rate is brought down, the deposit rate is not going up so quickly.
This is the first part of the problem, which is the very structural nature of the problem. Then comes what are the things that can change. So within the household financial savings, you can incentivize a little bit more coming towards bank deposit vis-a-vis small savings. So to that extent, the banking system liquidity might improve a bit. But again, this is not going to be an instantaneous process. The instantaneous solution that the markets would want is the liquidity provision by RBI, which in a sense is just kicking the can down the road because the structural solutions have not been taken. But still, as you might have already noticed, that the liquidity has become much more comfortable now.
Yes.
So if there is some kind of a guidance from RBI that liquidity will be kept comfortable in a quantity definition sense in the current level, I think that will provide enormous comfort to the markets. The markets don't really want liquidity to be surplus and repo rate to fall to the weighted average call rate to fall from repo rate to reverse repo rate. That does not happen in the current monetary policy operating framework. We have to accept that. But within that framework, if liquidity is kept in a quantity sense more neutral, I think that itself will be quite a bit of a positive from markets.
So a lot of communication is what you're prescribing.
A lot of communication is required, that this is the plan. The plan is not to keep structurally the liquidity to be in deficit and keep weighted average call rate at the upper end of the curve.
Okay. And to you, Soumya, now, is this enough? Because the dislocation is at a housing finance company space where people or banks are not even willing to lend or bankroll. So is just an accommodative policy or a comforting stance enough, or do you think something extra needs to be done as lender of the last resort? Buying stressed assets, something that was done in 2009.
No, I think. But before that, just a point to what Sajid said in terms of the small savings. I think it's always a very good suggestion to bring down the small savings, but I'm not sure whether the government can able to bring down that, because in the last couple of years, the government has been financing the fiscal deficit from small savings because it wants to reduce its reliance on market borrowings so that the yields are not impacted. So from that point of view, I don't know whether that is possible. Regarding the issue of your whether some sort of an window could be opened of 2009, I think the current problem with the NBFC is mostly of a solvency issue, because what is happening is that the better rated NBFCs are getting the funds and the NBFCs which are not better rated, they are somehow being distinguished. I think this is this is a natural course of the problem. Over a point of time, this problem will get sorted out in terms of who is a better NBFC and who is not a better NBFC, who is not a so much better NBFC. Regarding Samiran's point in terms of the quantity, I think that's a good idea, but my sense is that two things needs to be done. The RBI needs to be very clear that it is injecting durable liquidity and not replacing durable liquidity with frictional liquidity or transient liquidity like government cash balances. And the second thing, I would like to put the ball on the court of the RBI is that whether the RBI can give instructions to the bank in terms of some benchmarking, external benchmarking. I think that has been out in the public domain for a while. The banks need to see whether they could actually find out some mechanism where the assets and the liability side move together, because until and unless we don't walk down that road, it will be very difficult on part of everyone to transmit the way what the central bank wants. So sort of an asset liability
20 years
movement.
as a banking reporter with bankers and RBI trying to figure this out, BPLR and then PLR and then MCLR, base rate. And now, okay, they are trying to get external benchmarks. It's just,
but the asset and liability side need to move together.
Okay, should move together. I think it does, but maybe with a lag. Dr. Sen, no time limit for you. If you can put all these prescriptions together, do you think a separate window is needed to give comfort to the NBFCs? As well, what should the MPC ponder about liquidity, CRR cut, all instruments? What would you do, sir?
Well, I think the points that have been made sort of cover the bases fairly comprehensively. I think there are only two issues that one really needs to look at. The first issue is what the NBFC problem and the financial stability issue that Sonal was talking about. And then we have the alternate point of view that came later, which said, let the system fix itself for a while. And I think my personal view is that we really need to get this NBFC thing sorted out, and perhaps let it be sorted out in an organic way rather than through a direct policy intervention. Because what we've had is that over the last 10-15 years or so, the relationship between the NBFC and the banking sector has changed in a manner which I frankly think is undesirable. And now I think this needs to get sorted out. A lot of the weaker NBFCs need to go. There has to be consolidation of the NBFC sector so that something similar to what's happening in banking, which is stronger banks actually starting to take over weaker banks. This sort of thing will have to happen in the NBFC, and I think that's very desirable. Okay. The second issue has to do with liquidity. And this is really at the heart of the whole problem. Liquidity is not just for increasing the lending or having the transmission happening. We also have to keep a weather eye on what's happening to the exchange rates. Yes. And the exchange rates, again, do not fill you with joy. As it is, the world economy is weak, and if the Indian rupee continues to actually gain, if anything, in real terms it's certainly gaining, that's not good for anybody. And so I would imagine that the focus now really should be on liquidity and less so on the interest rate. I don't think the interest rate matters that much. And finally, on this question of external benchmarking, as a person who believes in markets, my gut reaction is that if you're going to fix the bank interest rate, whether you call it external benchmarking or call it fiat, it comes to the same thing. And I hesitate to get rid of an instrument which is telling me something about the market which I need to internalize and react to. So loss of information does not help anybody. And external benchmarking will lead to a loss of information.
Well, it also is a problem that not all our external benchmarks are very liquid. So that would be something that the External Benchmarks Committee will worry about. We have covered comprehensive ground. Chairman Sen has put it all together. On the exchange rate, we must remember that we are in very tense times, and it looks like China might retaliate rather severely, and the yuan rate to the dollar is coming close to 7. The heavens may not fall if it breaches 7, but it looks like at least we have the elbow room, therefore, to allow the currency to depreciate. Indeed, it must not appreciate, as Dr. Sen puts it. Well, gentlemen and lady, I think it's time we start voting. Let me once again start with the lady, Sonal. First question to y'all is, what is the action you expect, cut or hike, and by how much? Sonal.
Lata, we are expecting a 25 basis point rate cut.
Okay, thanks for that. Sajid, your take?
Lata, we think the MPC will also cut rates because I think they'd worry about output gaps opening up.
Okay, I wish you all would raise your boards adequately. Samiran, your expectation? 25 basis cut. Soumya?
You are expecting a 25 or could be larger than 25 rate cut, this policy?
Larger than is, I hope it's not 35.
That's debatable, but
Okay.
It could be larger than 25.
25, so it could be 50 as well. Dr. Sen, what would your prescription be? Okay, 25. I thought Dr. Sen would do even more, but the chairman doesn't have to do any casting vote. He agrees with his members. The next question to you is, what should the stance be? Since many of you have spoken about communicating effectively, I think the stance becomes important. Sonal, what should the stance be? They are at the moment in neutral, right?
It's a bit too late, Lata. So we think at this stage, stance will likely stay at neutral.
Okay, fine. Yes, I guess it would have been beneficial if ahead of the 3 rate cuts we had accommodative. But nevertheless, we have to do what we can. Sajid, what should the stance be?
Exactly the same, Lata. I think they realized after 2 rate hikes to change the stance. In your 3rd rate cut, I think it's not prudent to change the stance.
Okay, so neutral again. Shaviran, what your sense?
Similar kind of
again?
argument. So I think they missed the boat in the last policy.
Okay. I'm in the boat of accommodative. Anyways.
Yeah, it's basically should be neutral,
Neutral-ish.
a little bit turning towards accommodative, but I think I agree with the rest of the members that it is too late to change the stance now.
Okay. Say neutral, but try to sound more
Trying to be
accommodative in other parts of the
Yes.
statement. Dr. Sen?
I'm with you.
Oh, thank you. Thank you, Dr. Sen. Go accommodative, my sense is there may be more rate cuts. Well, actually, very quickly, Samiran, you think that, how many rate cuts do you think there will be, including the June 6th?
So I think the August rate cut possibilities are now open.
Okay.
So
One more.
Also.
Soumya?
Maybe one more, but it depends on how much you cut this time.
Okay, actually, I don't have time, but Dr. Sen, I'll squeeze one with you. How many rate cuts do you think before the year is out?
I think August they'll pause
Okay.
because they need to have a little bit of time for things to play out.
Okay, all right. Well, anyway, Dr. Sen has very clearly said that the stance should be accommodative and that should be communicated. Thank you very much, members of the Citizens Monetary Policy Committee, for your deliberations.